I'm Tim Chubb, and thanks for tuning into our second video of our quarterly investment current series. Today we'll dive into some of the key economic challenges in China and their impact on the global markets and economy. Fading economic momentum after the worse than expected economic boost from the COVID reopening has revealed a very new economy challenged by what we're calling 3Ds: debt, demographics, and deflation. So stay tuned and visit our blog at Girard.com to read our in-depth think piece on the topic coming soon. After abandoning its zero COVID policy at the end of last year, China's economic rebound has slumped, with strong domestic spending struggling to offset the reduced demand for goods from Western countries. The growth engine in China is unlikely to return to pre-pandemic levels thanks to changes in three key drivers: debt, demographics, and deflation. Whereas debt had previously fueled a growing middle class and high ownership rate, it now limits China's flexibility to respond to slowdowns given higher levels of debt to GDP. From a demographic perspective, the former one-child policy from decades prior has left a smaller workforce funding the retirement of a much larger wave of retirees. And finally, China stands alone worldwide in fighting deflation, not inflation. As the slide to the right shows, the Chinese economy has flirted with deflation twice in the last few years. Deflation threatens to torpedo the economy as consumers defer purchases, expecting prices to go down in the future. This is the exact reason why we need to have some inflation in the United States, but not too much. The real estate sector has been the canary in the coal mine, as we've all heard about China's relentless investment in property and infrastructure, leading to a growing middle class, but also countless ghost cities or empty cities and exploding debt. The recession in the industry that supported 1/5 of the economy worsened in the second quarter and is evident across indicators such as house prices to the right, transactions, and new construction. This comes on top of struggling private property developers defaulting on loans and plummeting home sales, as again seen on the right. This has renewed fears about financial stress in the real estate sector broadly, moderating consumer income and spending growth. We've recently seen signs of stabilization, but the jury is still out on whether the recent stimulus will be able to facilitate a more durable recovery. The good news is at least some of the property distress that we've seen has been priced into markets, or many bonds from the developers have already defaulted. Meanwhile, the Chinese Communist Party has been aggressive in residential mortgage market, lowering mortgage rates and down payment requirements to spur sales. While export volumes are down 2% from their peak in the first quarter of 2021, China has found new sources of export demand in their new economy, including clean energy and automotive exports. Middle Eastern and Asian neighbors have doubled imports from China for autos and vehicle chassis over the last 18 months, making China the second largest auto exporter globally, surpassing Germany and trailing just Japan. Electric vehicle, battery, component design, and production have also seen booming growth, providing early evidence of the efforts to rebalance their economy. In the meantime, the global supply chain is rewiring post-pandemic. Emerging market countries like Mexico, Vietnam, Thailand, and Indonesia have boosted manufacturing capabilities and grown their share of U.S. imports, while China's share has declined. In fact, the United States is now importing more from Mexico than China for the first time since 2003. Given the country's centralized concentration of power, China has some tools to engineer recovery, but it will not be easy. Our prescription for a durable recovery will need the support from 3 Rs: reflation, rebalancing, and reform. Bringing back a modest level of inflation is a must to avoid the deflationary spiral that plagued Japan for the last several decades. With this in place, China can continue to focus on rebalancing its economy to be more supported by the consumer consumption instead of government spending in the real estate market. This chart on the right shows a stark contrast in consumer contribution to GDP between China and the United States. Through policy, China will attempt to shift the growth engine to the emerging middle class, so it is less reliant upon the volatile property sector, which makes up more than 20% of the economy. This rebalancing will enable the country to experience more predictable growth and more self-reliant growth. Lastly, reform has been on the administration's focus for decades, but the government really stepped up in 2013 by merging large state-owned organizations to increase efficiencies. The idea is to allow the Chinese government to move from running thousands of disparate businesses to focus on policy to drive innovation and economic growth, from managing assets to managing capital. Whether an investor owns only U.S. stocks, index funds, or actively managed mutual funds, the Chinese economy will impact their portfolio. In fact, sales from China account for over 4.5% of sales in the S&P 500. For index funds, investing globally, China is an important component. For example, China makes up about 1/3 of most emerging market indices and almost 5% of the MSCI All Country World Index. Recently, and unlike the past, there has been a decoupling between Chinese shares and those of other emerging market economies. Many non-China emerging market economies have a younger, more dynamic workforce, population growth, and are benefiting from the rewiring of the global supply chains that have supported China for the last 40 years. Examples include India, Indonesia, and Brazil. While we would not be surprised if Chinese stock market valuations find a bottom soon, the broader universe of emerging market valuations as a whole has compressed broadly on a rising US dollar and high oil prices. It used to be that as China goes, so goes the rest of the emerging markets, but that doesn't seem to be the case anymore. So what's next? Recent statements from the Communist Party's top decision-making body suggest policymakers understand the risks to growth and are ready to step up efforts to revive lackluster domestic demand. That said, we expect leadership to be measured in their approach, balancing efforts to reflate, reform, and rebalance to manage debt, demographics, and deflation. Investing in China will remain controversial, so it's important to know the facts about their economy and policies. Thanks for joining us. You'll be hearing from us one more time this month with a dive into how to get your financial house tidy as we enter the new year.